Hello and welcome to Indianomics. Well, bond yields have fallen from a high of 6.2% in the end of August to below 6% today. But the government borrowing program in the second half is most likely to be higher than expected, given the tax shortfall. The Expenditure Secretary almost admitted that. How much higher will it be? What tools does the Reserve Bank have to manage the borrowing program? And will an appreciating rupee affect the RBI's ability to buy bonds? Remember, the rupee has appreciated from a low of 76.9 in April to 72.9 in early September. The dollar became cheaper by 4 rupees. Now, can the RBI buy both dollars and bonds? And what about bond yields? Will they fly towards 6.5 as we come to terms with higher borrowing? Or does the Reserve Bank have enough space both on liquidity and to cut rates? Will the cuts be effective at all? To answer all these questions, I have with me B. Prasanna, the head Global Markets Group at ICICI Bank, Soumya Ghosh, Group Chief Economic Advisor at State Bank of India, and Neeraj Gambhir, President, Head Treasury and Markets at Axis Bank. Practically the top three in the bond markets. Thank you very much, gentlemen, for joining me. Well, Soumya, first to you, because we need to know the terrain first in terms of growth, tax collections, and therefore revenue shortfall. And for the moment, I'll only stick to the centre. Okay, now what are your tax assumptions? We will have some numbers running. Nominal GDP, which had fallen from 11% in FY19 to 7.2% last year, itself saw, a flatness in tax collections. Even when nominal GDP was 7.2, the tax collections were flat. This year, what are your nominal GDP estimates, and therefore, what will the tax collections be?
Yeah, I think this year we're in very difficult times, and as of our last estimate, I think the real GDP number was at minus 10.9%, and the nominal GDP contraction could be such that we'll be possibly going below FY19 nominal GDP. So I think that number was at around 189 lakh crores. So we had a government projection of 224 lakh crores before the pandemic broke out, but it might slip below FY19 levels if the way things are moving right now. Now, having said that, that will have a significant impact on the tax collections numbers for the government and the state. If you actually look into the total tax shortfall of the government and the states, and which we call the uncovered loss, basically the loss which cannot be covered by even the borrowings which the government and the states are doing, I think for the center, the states, the number is around 4.7 lakh crores revenue slippage, and the uncovered loss is 3.2 lakh crores. That means that amount of loss the states has to manage through expenditure cuts. And for the center, the revenue loss and the net revenue slippage is around 6.5 lakh crores, and the uncovered loss is 4.2 lakh crores, means that amount has to be adjusted against expenditure rationalization. So overall, the center's fiscal deficit could be in excess of 8%, and the state's fiscal deficit could be closer to 5%, which means a consolidated fiscal deficit of the center and states of around 12.5%.
Okay.
So that's the number which I want.
Right. One minute. Let me just get to the number that our government may have to borrow. The government said it would borrow 8 lakh crore in the beginning of the year. Then it increased it by about 4 lakh crore. Actually, well, to be precise, 4.2. So it became 12 lakh crore, of which it has already borrowed, I think, 6.1. Right? So what is your estimate now of the borrowing? Will it be more than 6 lakh crore? Will it be, 8? What may be the borrowing figure we should be prepared for?
See, Latha, as of now, the total gross borrowing estimate is around 21.6 lakh crores. The center gross borrowing is 12 and the states is 9.6.
Yeah.
So that means, but given the way things are currently moving, we believe that this number has an upside bias, and the way the things are moving right now, I think you could end up having a gross borrowing number, which will be at least 10 to 15% higher than this number.
Okay. Well, Neeraj, would you have a fix? The expectation, I'm only looking at center now because states will complicate things. The government borrowing program itself is expected only next week end. They've borrowed 6.1 already. What may they borrow in the second half, you think?
Actually, Latha, they've borrowed a little more than 6.1 because they have been taking over subscriptions in the auctions. And they have also borrowed through the T-bill route, which is, if you put both of that together, they have borrowed approximately 11.5 lakh crores so far from the market, right? So now the question is that given the size of the borrowing that they have done, what is going to be the borrowing strategy for the second half of the year? My base case is that they will, for the sake of announcement on 30th, they will stick with the 12 lakh crore number. Because if we go at the pace at which they have gone in the first half, they will be able to finish the 12 lakh crore number by, let's say, end of, I would say, January. That will leave them the months of February and March to accommodate any additional borrowings that they might be required, depending upon how the picture is playing out from a fiscal standpoint. Because there is still a lot of uncertainty between now and January on how the numbers actually play up. What is the actual level of economic activity that we see, etc. So that's my best guess estimate at this point in time of the strategy. So I don't anticipate a number which is higher than 12 lakh crores as far as the second half of borrowing calendar is concerned. I do expect that the amount of borrowing that they have done in the form of treasury bills, which is approximately 4.5 lakh crores, will continue to be there till the end of this year, will probably not be repaid out or converted into longer dated bonds. If by January, February, the markets are looking better and their fiscal finances are looking slightly better, there may be change in this equation. But I think that's my best case scenario. Base case scenario right now.
Prasanna, good morning. What would be your base case? Do you also think they won't spring a surprise in the borrowing program? They will stick to 12 lakh crore, and therefore the second half borrowing would be how much?
So, Latha, I think I agree with Neeraj on the fact that purely from an announcement perspective, I don't think they are going to, actually commit themselves to any kind of extra borrowing at this stage, because there is still a lot of time to still go ahead with. So I would presume that they will stick to the budgeted borrowing program of 12 lakh crores. But if you have to really look at it, they'll probably close the borrowing maybe by mid-Jan or late Jan, so that they could afford themselves a little bit of extra time and space to borrow extra if it were required towards the month of February and March. Where I probably disagree a little bit with Neeraj is on the use of treasury bills versus the use of dated securities. So I do feel that while they have borrowed quite a bit in treasury bill at this point of time, going forward, I think the government would want to reduce the reliance on treasury bill, because then it is a problem for next year. And I think this government has been responsible in the past in terms of how they manage the next year's borrowing as well. So my assumption would be that as we go towards January, February, they would try to bring in a little bit of reduction and reliance in treasury bill and actually come into the dated security borrowing. So if they have to really look at it, I would assume that there is a possibility of a total extra borrowing of around 1.25 lakh crores, out of which they have already done 70,000 crores in terms of green shoe option. So they would possibly rely on a green shoe option method to, fund this extra borrowing in the second half. So I don't think the market is going to be shocked with the number which is going to come out on the borrowing program date. But we'll have to watch that number as we actually go ahead.
Okay. Now let us assume they come only with the number that both of you are saying, about 6 lakh crore for the second half. Now, if that is the case, do you think that bond markets, we could see bond yields falling from here on? Or do you think the Reserve Bank will have to do some heavy lifting? Prasanna, first you.
Latha, I think bond markets are on tenterhooks always. So the fact that they're going to announce a borrowing program which is as per the calendar, of course, market will be a little bit relieved that there is no shock number if that were to happen. But at the same time, if the borrowing program is going to finish by January, the people can read through the lines and estimate some kind of excess borrowing coming in the month of February and March. So the market is not going to run away and yields are not going to fall too much. On the other hand, if RBI RBI has done everything right so far. They have been using quite a bit of tools to contain rise in yields, and whenever you have seen yields go up by 20-25 basis points, they do a combination of devolvement on the primary dealers and immediately follow it up with Operation Twist announcement with an appropriate choice of security. So they've done kind of everything right so far. Maybe you could quibble on the timing. I mean, they might have to do it earlier than what they have been doing so far. But other than that, I think the job of RBI would be to prevent a rise in yields rather than to bring down the yields too much. I think that's the way I would like to look at it, because of the fact that there is such a huge borrowing program. If RBI is not active in managing it, then you would actually see a rise in yields. And so if RBI is active in managing it by the way they've been doing it so far, Operation Twist, and maybe come out with outright OMOs, then they could actually contain the effect of rise in yields. Okay. So I'm not looking at a big fall in yield. And if yields go up, I'm expecting RBI to proactively come and manage.
Okay. So Neeraj, on September 29th, or whenever they announce the borrowing program, or maybe next Friday, you don't expect, I mean, like Prasanna, you are also you're saying that they will announce the same number that is in the budget, about 6 lakh crore. You don't think the RBI needs to proactively announce anything in terms of an OMO calendar or anything? That number will not disturb the market.
See, as we speak, given the interventions that they have done in the recent past, the fact that they have increased the HTM limit for the banks, they've announced Operation Twist. The market expectation is that the Operation Twist is something that will continue, whether or not they announce the calendar on September 30th. And that's absolutely required for the yields to continue to stay where they are. So kind of agree with Prasanna that if the number is along the expected lines, and given the fact that there is always a possibility that they may come and borrow additional in the months of February and March, I don't expect the market yields to actually go either higher or lower in a meaningful way on September 30th. But the market will always be watching for what Reserve Bank is continuously doing in this space. And if there is and so far what we have seen is that Reserve Bank has actually given very strong messaging to the market whenever the yields have gone beyond 6%. So 6% seems to be the line in the sand where we've seen very strong intervention, both in the form of policy action as well as in the form of open market operations. So I think if that trend continues, I would think the yields will remain somewhat anchored here. And the market will expect Reserve Bank to do some steps or take some additional steps if the yields were to meaningfully rise, let's say beyond 610, 615 level, for whatever reason, if they were to do so.
Okay. Well, just a word from the economist before we proceed. Soumya, are you in agreement with what Prasanna and Neeraj are saying in terms of the market borrowing on next week will not be a shock? What do you think will the ultimate borrowing be? Prasanna says that it would be 1.25 more, of which they've already done 70,000 crores. So the extra may be only another less than 1 lakh crore. It would be maybe another 60,000-70,000 crore. Is that what you also expect, or do you think it can be more than that because the tax shortfall may be more than what we're all estimating?
No, I agree with Prasanna to some extent. That's why I said at the beginning that this number could be 10 to 15% higher than the 12 lakh crores. And please remember that the number which I mentioned at the beginning, that is the borrowing through dated securities. So that's why it is 6 lakh crores. Now, but the issue is of uncertainty. So we don't know how the tax collections are going to shape up. And if the recovery gets more protracted, which it seems most likely right now, I mean, the numbers, the gross borrowing numbers could remain a tad uncertain and could go a little higher. But I agree with both Neeraj and Prasanna that the next September, they will stick to this borrowing plan, and possibly they will look into it more carefully, maybe towards the Q4 of the current fiscal.
Okay, fine. So bond market unlikely to throw any major shocks. The government borrowing announcement will perhaps be a smooth event. That's the first takeaway from my guests. But there are a couple of things that I want from you all. One, therefore, what will be the bond yield range that we will look for in the second half of the year? And more importantly, can the rupee spring a surprise? I mean, we have seen systematic depreciation of the dollar, and therefore, will the RBI be called upon to buy too many dollars? And if that happens, will there be an unmanageable liquidity situation, given the way inflation is panning out? Will that be an issue? Those questions in a minute after the break. Welcome back. We are trying to look at how the bond market will receive the government's borrowing program, which will be announced next Friday mostly, and whether we can get a fix on whether the government's borrowing will be over the 12 lakh crore Remember, for the budget, the government said that it will borrow around 8 lakh crore, and then it added another 4 lakh crore. So the current borrowing program is 8, but they've already managed a little more than half that number in the first half. I have been speaking with Soumya Ghosh, Chief Economic Advisor at SBI, B. Prasanna, the Head of Treasury at ICICI Bank, and Neeraj Gambhir, who heads the Treasury at Axis Bank. Just a word on this budget numbers, Soumya. What are you going with by way of tax collections? I mean, I'm just coming back to the point that, we already saw a big fall in nominal GDP last year from 11 to 7.2, and the tax revenues were flat. Now, when nominal GDP becomes -6 or something, as you said, 189 lakh crore or thereabouts, then what is your estimate of tax revenues? I think the budget said 16.5. So will we make it to 12, 11, what?
I think as of now, we are going with an estimate of around 12 lakh crores. So basically a shortfall of around close to 4 lakh crores. So that's a number which we're working on. But as I said in the beginning, Latha, these numbers are uncertain. And I'll not be surprised if this number has a downward bias. So as of now, the shortfall of 4 lakh crores seems to be a little more appropriate. But I don't rule out larger slippages if the economy doesn't pick up as expected.
Okay, fine. But we will come to know that much later, perhaps only by November or December. Okay, the other small irritant which the bond markets may have to worry about is the state borrowing. Soumya, what are your numbers? How much more may the states borrow via SDLs?
See, the states actually, if you look into the numbers right now, the government has completed around close to 50%, and the states, I think the number is close to around 30% or so. So, and the logic seems to suggest that every year the states actually front load the borrowing requirement in the last quarter. So that could actually be a problem, because if close to, I think, 8 lakh crores is the state's borrowing, I think out of 22 trillion gross borrowing, a little more than that. And if a large part of that comes through in the last quarter of the fiscal, so the central bank will have its hands full in terms of managing the expectation. But as we said at the beginning, I think the central bank has been doing a great job in managing the yield expectations. And just one line I will add is that if you make a comparison with the global financial crisis and the yield differential at that point of time, that was 350 basis points over and above the policy rate. So currently, by that logic, the yield would have been higher than 7%. So, but given the fact that it is close to 6%, means that the central bank means business, and it has been aggressively intervening in the market.
Yeah. I think the governor made it very clear that we are at the lowest level in a decade. So clearly, good yield management. Just very quickly, if we can dismiss that point, Prasanna, do you think the state borrowing will anyway disturb yields?
So that's something that the market has to contend with, Latha, because at the end of the day, it is like almost 100% risk-free curve, and any increase in the state borrowing will exert pressure on the long end of the GSEC curve as well as the corporate bond curve. So sometimes state borrowing is a sector that nobody looks at, and it ends up influencing both the government bond deals on the lower side and the corporate bond deals on the other side. But it's very, very important that that's also taken into account by the Reserve Bank. And I think RBI understands that it can't do much in terms of directly buying the state government bonds in the market. So I think all its intervention is going to come through open market operations and Operation Twist in the government bond market to influence the state development bond deals as well.
Okay, so
and the HTM hike also helps in containing the rise in yield.
Okay. Neeraj, anything you want to add? Will the state development loan, and according to Soumya, that is going to be a fairly large, about 5 lakh crore of borrowing from the math he put out. The state's borrowing table will come up for you again. Of course, these are SBI's estimates. But will that make corporate loans expensive? Will it anyway disturb the bond market?
So the size of state government borrowings is a cause of concern for sure, and the numbers that that has been put out are kind of the numbers that tell us that this is where we probably will have a negative surprise. But so far the markets have been pretty sanguine about it. If you look at the spreads of state loans versus the government bonds, I mean, they were at a pretty high level of 125, 150 basis points a few months ago. and now we are down to about 55 basis points. So I think the markets are kind of seem to be taking this a little bit in their stride, we will. And the part of the reason is that states have actually borrowed less than what they actually put out so far. Going forward into the second half, we'll have to see what exactly is the strategy that the states use in terms of their borrowing program. I do worry a little bit about the size of the state government borrowing program and its impact on the bond market. I think the spreads that the states have to pay over the central government could probably widen a little bit. And if that spread widens, then obviously it has a follow-through effect on the rest of the bond market. So I would say that's something that needs to be watched out for. And probably needs to be taken into consideration.
Okay. Well, now let me come to the rupee, and then I will want your bond range. What's your sense, Prasanna? Do you think we are going to see a continued depreciation of the dollar, and therefore will the RBI be called upon to buy like they bought last year? They bought in the first 6 months?
So I think Latha, the classic case of the impossible trinity is what is actually playing out in the bond markets in the central banking environment in the first 4-5 months for RBI. So basically, you've seen a lot of FDI flow coming into the system. RBI preventing the rupee to appreciate, have bought a lot of dollars. They've infused more liquidity into the system. And in order to sterilize that liquidity, they've actually paid in the forward market to postpone that liquidity to a forward date. That takes the forward rates up. And that has made, carry trade more attractive and resulting into more inflows into the country. So this kind of, the circle is complete. So what RBI has done so far is to try to, so you can't really manage interest rates, exchange rates, and allow free capital flows. That's what the impossible trinity is about. So I think RBI going forward will have to, in my opinion, have to choose to be on the side of letting flows come in as well as not let interest rates go up. And my presumption would be that they might have to let the rupee appreciate a little bit rather than actually go and intervening to prevent it from appreciating. They've not been allowing it to appreciate in the past because of the obvious competitiveness logic and the fact that the exporters get a very raw deal if it appreciates. But we are reaching a situation where just because they are intervening and preventing the rupee from appreciating, more liquidity is coming into the system, and that liquidity is actually RBI, by sterilizing the need to sterilize it, they're actually ending up pushing up short-term rates. So from that perspective, I would assume that, and also keep in mind that the current account deficit and the BOP flows overall are looking very positive for the economy as such. So from that perspective, I think a little bit of appreciation is possibly called for at this point of time to ensure that rupee goes to maybe a 72 to 73 half kind of a range rather than the 73 to 75 range that we have seen over the last few months.
Okay. Well, actually, it looks like, I'm just doing a quick math, the Reserve Bank has bought close to $65 billion in the first 6 months of the year. Neeraj, now will this create a liquidity problem? I'm asking you because just for those who don't follow this market very closely, every time the Reserve Bank buys dollars, it is putting rupees, a matching amount of currency in the system. When it buys bonds, also it does the same thing. And liquidity in the banking system excess was running at 7.5 lakh crore for a better part. The Reserve Bank showed some kind of discomfort maybe about liquidity when inflation started rising. That is why they took back the TLTRO money maybe, or maybe they took back the TLTRO money so as to give themselves elbow room to do OMO. I don't know. But do you think there will be a problem, Neeraj, that they can't go on increasing the liquidity? There may also be a cap because there is a limited amount of bonds with them. What, 10 trillion bonds they have? They can't put more liquidity than that, can they?
So it's a slightly more involved and complex answer. First of all, on TLTRO, TLTRO reversal is liquidity neutral because currently what's happening is that the banks have borrowed money from RBI under TLTRO, but they're also giving that liquidity back to Reserve Bank on a short-term basis and an overnight basis. So effectively, it reduces both the sides, the amount of borrowing that they have done and the amount of the lending that they're doing on a daily basis. So I think TLTRO essentially is reducing the cost for the banking system, but it's liquidity neutral. As far as the liquidity management for the second half is concerned, I think the drivers in my mind are basically what is going to be the net FX flow in the second half of the year. if the economic activity picks up, and bear in mind that our current account deficit tends to be correlated with the economic activity. So if the economic activity picks up, you could have a wider current account deficit.
Okay.
So that could actually lead to some pressure off from appreciation standpoint. The second point is that how does dollar behave between now and, let's say, end of the year? Remember, we are in a US election cycle, and there is some expectation that we could see some dollar strength during this phase, and also some emerging market weakness. If that happens, there could be lesser pressure on rupee to appreciate. The third factor that I think that needs to be borne in mind is that in this last 4 or 5 months, we've seen a very large amount of FDI flows. And those FDI flows are the ones which have actually kind of helped rupee appreciation.
Yes.
So whether the same size of FDI flows will continue in the second half, and once the current accounts start off widening up, then what's the net flow story? If we go just by the balance of payment numbers, I think Reserve Bank probably needs to buy another $15 to $20 billion in the second half of the year. And if they were to indeed buy that amount, then the amount of liquidity that they will have to release in the system is roughly, say, about 1 lakh or 1.5 lakh.
So we are
Latha, can I just bring in a point on liquidity? So basically your point on LTRO, RBI sucking out liquidity, I think some of the market participants have possibly, according to me, misread the signal and thinking that they're actually withdrawing liquidity because it could be inflationary. So my personal view is like very similar to what Neeraj said. Excess liquidity is a tax on the banking system, and you would admit that the entire banks together are effectively borrowed in the case of LTRO at say 5.15, and they are giving to money to RBI at 3.35.
Yes.
So this is like a negative carry for the banking system. So RBI in its wisdom actually decided to bring down the negative carry and make the banking system more profitable. I don't think we should read more into it.
All right. No, I mean, actually, also because we're running out of time, the markets basically want from all of you experts what will be the cost of money. So you'll have to give me very quick answers. This is rapid fire. Neeraj, what will be the 10-year yield from now to December and December to March? Standing where we are.
I think for me, the broad range is about 590 to 6.25. I think that's where I'm looking at. I'm not looking at too much of volatility in this.
Okay. Prasanna?
580 to 620.
Okay. Soumya, one more question to you and then the bond yield question. Will there be any rate cut that we have to expect from now to March? And what is the bond yield range?
No, I don't. As of now, we are actually not expecting any rate cuts. Possibly, if a rate cut happens, that should be in February. And just 1 second, I'll add one point to the discussion which Prasanna had. I think the central bank in India has a very strong bias in preventing rupee depreciation and rupee appreciation. So you can actually expect the rupee to appreciate a little bit. And in terms of the bond range, it should be between 595 to 620.
Okay, so then it's really going to be placid bond markets. Very quickly, I'm overshooting time. Dollar rupee range, Prasanna? Same period, second half.
72.5 to 74.
Neeraj?
I think I'm somewhere similar, about 73 to 74 half or so. I'm a little bit more depreciation possible in my
depreciation possible. Okay, gentlemen, thank you very much for joining me. The big takeaway for all markets and all viewers here is that don't expect too much of volatility in the bond markets, irrespective of the fact that the government may have to come and borrow a little more than originally expected. We wrap up on this note. Thank you very much for watching. We are back in a jiffy.